Hi everyone. So we'll be just starting the webinar soon.
Hi Ayush. Ayush, you need to give me access to share my screen.
Yeah, Vivek, is it good now? Can you share the screen?
Yes, I can share, but Ayush, your voice is echoing. Yeah, and can you see my screen? Ayush, I've shared.
Yeah, I can see your screen, but just
I think there are already few people who have already joined. So can we start, Ayush?
let me just check this issue just for 2 minutes and
Okay.
then we can start.
Sure. As we'll just start in a moment, facing some technical issue. As we'll just start in 1 minute.
Yeah, I think it should be good now.
Okay, yes, let's start, Ayush.
Yeah,
Yeah, your voice is fine. We can start. Okay.
right. Yeah. So should we wait for a few minutes, or I believe everybody has
I
joined?
think, yeah, we are already behind time. So let's start.
Okay. So we can, if you can share your screen, and yeah.
Okay, I've tried sharing.
Okay.
Yeah. Okay, let's start.
Yeah. So if you can go to the third slide. So I would like to introduce Estee first. Yeah. So first of all, thanks everyone for getting along today with us on a uh, weekday evening, and thanks for the tremendous response that we have been getting onto our products, Good Luck and PMS. So very happy for all of you to be here, and we'll be talking about our PMS services in detail with Vivek, who heads the investment head at Estee, and the Good Luck services as well. So talking more about Estee, so we are a pioneer in systematic investing in India and started our operations back in 2008. So over the past 15 plus years, we have been developing leading investment products and broking products using analytics and computer science. Along with that, we run our PMS services in India, good luck, and we also are a broker to the FIAs and FPIs that invest into India. We also won the NSE Institutional Member of the Year award back in 2019. And cumulatively, including our international products as well, we hold around 1500 plus crores. Along with that, we have served around 25,000 plus retail, HNI, and institutional investors in the course of all these 15, 16 years. So, moving forward, I will also tell you more about Sandeep Tyagi, who is the founder of ST Advisors. So Sandeep did his BTech from IIT Delhi and later on went on to do his MBA from Columbia University. And after that, he founded a firm by the name of Inductus. Later on, he sold that firm to EXL. That firm was primarily engaged in data-driven consulting to the top institutions. After that, he founded ST, and now he has around 30 plus years of experience in portfolio management and analytics consulting. Then about our host, Mr. Vivek Sharma, he, as you know, heads the investment overall India asset management, and he did his BTech and MTech from IIT Kharagpur and has 20 plus years of experience in trading and investment management. So on to you, Vivek.
Okay, thank you, Ayush. Thank you, and welcome everyone. So today we are going to talk about asset allocation, and the reason why we have picked up this topic is because of the past few months, the conversation I have been having with a lot of our clients and uh, other investors. They've primarily been. I've seen a trend, and that trend has been that most of the investors who were really concerned about the fall that we have seen since last year September, and now we have seen some recovery, but since last September we have seen decent fall depending on where you have invested. So large caps anywhere between about 15% or so, and small to mid cap it could be depending on the stock and how many you have in your portfolio, it could be anywhere between 20 to even 40-50% as well. And the common trend that I was talking about has been that uh, that any investor who has done asset allocation properly has really been able to ride this storm pretty well. Whereas people who have been highly concentrated have either gone out of markets or have suffered huge losses and their sleep as well, right? So that's why I thought maybe we should cover asset allocation because this is a topic which sounds a bit boring, and also it does not get discussed very much, but we at ST believe it has huge implications on your overall portfolio returns. And it's not only us, a huge number of academic studies and surveys that have been conducted in which it has what has been found out is contrary to the popular opinion. What most of the investors we believe that maybe market timing is the main driver of the returns in our portfolio, or it is security selection, whether the stocks that we select or the mutual funds that we select, they are the uh, primary driver of the returns. But that's not the case. The case is that majority of the returns can actually be just attributed to the asset allocation, and very little uh, uh, impact market timing and security selection has on the overall portfolio returns. So what uh, so from this slide, what we can conclude is that where you invest, the asset mix is actually much more important than what exactly you invest or when you invest, right? And as I told you, many of the PMS investors withdrew. They couldn't hold on to the losses, withdrew at in Feb, March, when we were seeing huge losses. And now they're really repenting that they were not able to hold on. And I don't think it's their mistake. It's the mistake that they were not really, they didn't have a very well diversified portfolio. And that's why they couldn't ride that storm, right? So broadly, these are the multiple asset classes that we typically invest in. Each has its own pros and cons, right? And the diversification, as Harry Markowitz says, that diversification is the only free lunch in investing. Uh, why diversification helps? I think broadly, we would all understand that it helps us ride these kind of storms. It makes our portfolio stable, and what that results in is that we are able to hold on to our overall portfolio for much more longer time, and that's where compounding kicks in, right? So it is not about the portfolio that can give you the highest returns, but it's about the portfolio that you can hold on to for the longest period of time so as to gain the maximum impact of compounding, right? And that's why everyone should invest, it should diversify. This is one of the examples that if you have invested in, let's say, just one stock, a very extreme example of, let's say, an airline, and if oil prices spike, then this stock price could fall sharply, and you are fully, because you have taken a concentrated bet, you're fully exposed. Whereas if you have invested half of it in oil company as well, so you are kind of hedged. So overall, your portfolio is smoothened out, and you're able to hold on to your portfolio much more longer, right? So one should, when looking at diversification, uh, when it only helps if we have allocation to multiple lower correlated products, right? And that's why many times it becomes very hard to diversify, because like in the past few years when the equity was really doing very well, uh, we all thought that maybe equity is the one where I should stay most invested. Uh, and and uh, by the logic of diversification, if you have invested in a product which is very has very less correlation with equities, then by design that product really won't be doing very well, right? And that's why it becomes hard at times to remain diversified, uh, because being diversified actually means that you have invested in few of the products that are not doing very well at that point of time, right? And another aspect to this is, it's a very famous quote by Warren Buffett, that be fearful when others are greedy, but and also be greedy when others are fearful. I have heard this a lot many times, and I'm sure you would have also heard about this quote. But I really understood the significance of this quote when, uh, during my initial investing journey, markets had corrected, and I had invested everything because my risk appetite, I believe, is on the higher side. I'd invested everything in equity markets. Markets corrected. But what I wanted to do at that point of time was to take more allocation. I didn't have anything to allocate because I had already allocated to equity. All my 100% of the portfolio was already in equity. So if I had diversified, let's say, some part of it in debt, then I would have that dry powder, that if markets correct, I can actually invest at lower levels in the market, and when the market's correct and it's trading at higher levels, I can again move back to debt, right? And that's the power of diversification, that you get that dry powder as well in order to invest when the markets have fallen down, right? This is a practical experience that I actually learned early on in my career. Now, here, in the context of diversification, I want to speak about two of our products which are having almost zero correlation. So on one side, right hand side, we have long alpha, which is long only equity product. It moves. It's very much, obviously, because it is equity. It would be very much correlated with any of the equity indices. And on the left side, I have I alpha, which is similar to the risk return profile of I alpha is very much similar to that of any debt product. It's a market neutral arbitrage strategy. Now, this I alpha we have been running for 15 years and have generated almost 12% net annual returns since inception. And the interesting thing about this specific strategy, I alpha, which is being run in a PMS structure, is that it has zero negative months. So every single month in its track record of almost 17 years has been a profitable month, right? Whereas long alpha, again, it has a decent track record of 5+ years, and we have been able to give 29% annualized return. But the main point that I want to highlight here is that the correlation between these two is zero, and that's why that's what we propose to most of our investors, that if you have invested only in long alpha or only in I alpha, maybe that's not the best strategy for you. The best strategy is to be diversified across these two products. Now, in Estee, we have a gear-based investing approach in which uh, we got it from driving. So if the road is fine and there's clear visibility far out in the head, there's very less traffic, then you would want to ride your car at a higher gear. Whereas if there's lots of traffic, the roads are not very good, or maybe let's say there's a fog out there, then you should really not be driving at a higher gear. Then you should be driving your car at a much more lower gear. And that's how we also uh, we also practice in investing that for any aggressive investor, you should have a much higher equity allocation, which means you would be invested in a higher gear, either a gear 5 or a gear 6. A moderate investor should have a balanced approach, which means about either 60, somewhere around 60 to 40% in equity, and a very conservative investor would have about maybe 20% in equity and rest in debt. Depends on your risk profile, depends on your needs. Right. Now, if we look at the risk versus return of these gears, gear 6, which is 100% invested in long alpha, and 0% allocation in I alpha, has given about 31% returns in last 5 years. And the standard deviation, which is a measure of risk of any product, it is about 18%. So that is in line with, I think, most of the equity indices. They have about 18% or so uh, of standard deviation. So with that kind of standard deviation, we have been able to give almost double the returns of index. Now, if you move down to gear 5, it has 20% allocation to alpha and 80 to debt, 80 to equity. And even this has given us about 28%. The returns are slightly lower, but then the benefit here is that the standard deviation of the volatility of this specific gear 5 portfolio would be lower, and so on and so forth. So gear 4 would have even lower volatility. The returns would slightly come down to about 25%, but if you consider 25% is the amount of returns you need to double your capital in 3 years. So at 25%, slightly less than 25%, you'll actually double your portfolio in about 3 years' time with a fairly low volatility. And so on and so forth. So gear 1 is purely into alpha allocation, and the 5-year returns have been about 12% in that, which is again a fairly healthy return considering it has zero negative month up until now. Yeah. Here, what I have also shown is Estee's 60-40 portfolio versus BSE 500. So 60% in long alpha if somebody invests, and 40% in I alpha. In that case, this portfolio has given about 23.7% returns. Versus if you had invested everything in BSE 500, then you would have received about 16.5% returns. But the interesting thing is about the standard deviation also. So here, returns wise, we have given almost 50% higher returns than BSE 500. But in terms of the risk, we are taking 50% lower risk also. So our risk is actually lower because we have invested about 40% in the I alpha scheme. That's why risk has been lower. and the investors who have been following this approach are very happy with the kind of returns also, and with the kind of risk that we are taking in this specific strategy to generate these kind of returns. Okay, so I'll quickly take you through these two products. First is the iAlpha, which was started way back in 2008. Successful track record, as I've already told, zero negative month. And what we are doing in this is we are doing pure arbitrage. So we are trading in futures, and let's say Nifty is there. So I pick Nifty and all its 50 components. So I can buy Nifty futures, or if I want to buy Nifty futures, I can as well buy all the 50 components in exactly the same weight that they have in Nifty. And I keep tracking where a synthetic Nifty, which is the made from the components, is trading versus Nifty. And wherever there is a decent gap between these two, I'll go long in the undervalued product and go short in the overvalued. And when at the end of the month, when futures expire, they'll converge exactly at zero. So that spread will be zero, and I'll make my profit. Um, and that's the trade. It's pretty simple because we have this low latency infrastructure in place that we have developed in house, which actually trades in nanoseconds and microseconds. We have been able to make this trade and generate decent returns for our investors. Right. This is the monthly performance and also the yearly performance. So if you look in the beginning, obviously we are producing huge returns, but even now I think we have somewhere settled down to 12 to 13%. That's the expected returns from this specific product. Um, and even this year, it looks like we are on track. It's been 5 months and we have generated about 5.6% in this. Again, a pretty consistent product. The worst months would be somewhere around 0.5%, whereas the best months would be somewhere around maybe 1.5%. But that's the broader range. So you'll always be hovering around plus or minus 1%. That's how you end up achieving about 12 to 13% returns on an annualized basis. Yeah. So that was the debt product that I was talking about, an arbitrage product, which we are offering under the PMS scheme. And the second one is about long alpha. So in long alpha, this is an equity long only based product. Again, we have been running it for more than 5+ years. So it has a decent track record. It is purely quantitative in nature. We study more than 100 plus factors. So you might have heard about momentum or value. So a momentum fund, what they'll do is any stock that is in momentum, they'll try to pick that specific stock in their portfolio. Or a value-based fund, what it will do is it'll pick the stocks that are undervalued based on some or the other metric. They'll pick the stocks that are undervalued and only select those for their portfolio. What we are doing is we don't have any favorite factor. So we have 100 plus factors, but more importantly, dependent on the market regime, we pick and choose the factors that are most likely to work. Again, all of this is based on quantitative models that we have developed in house. It's never our bias that it come into play, that I feel maybe defense stocks are very good or I feel banking are not very good. It is purely data driven, so all the biases are removed and we are able to make very objective decisions while constructing our portfolio. And that's why if you see the active returns, these are the returns over and above BSC 500 that we have generated over the past few years. You can see we have generated very good alpha. So some of the worst periods, you can see 2022 is the period where we didn't do very good. We had about 8% negative alpha. And this year also the start has been slightly slower, about 5% negative alpha. But if you consider the years where we have done well, we have been able to generate almost 20 to 30% alpha, 20 to 30% over and above what BSC 500 has given. So I think in 2023, yeah, here are the returns. So in 2023, BSE 500 gave about 27%. We gave about 57%. Same with year 2021, where it was a very good year for us. 31% in BSE 500, 55, 56% in long alpha, and 2020. So overall, I think that's the trend that one should expect from these active funds, that over any 5-year period, if you have maybe one or two bad years, one or two average years, and one or two good years, overall you'll have a pretty good run, right? So that's what has happened even this year, although slight struggle, but that's part and parcel of any active fund, that when your strategies are performing, you lose less. But when your strategies are not performing, you lose less. But when your strategies start performing, that's the time whether you are able to maximize your returns or not. And as the history has shown, at least in the last 5, 6 years, we have been able to do that. Uh, and as I said, the risk that we take in this is similar to what is there in BSC 500. So the volatility of these portfolios are kind of similar in this. So anyone who has invested 50 lakhs in May 19, when we revamped our portfolio, till now would have been sitting on about 2.4 crores of portfolio, whereas in BSC 500 this would have resulted in a 1.3 crore portfolio. So pretty healthy gap between this that we have been able to create for our investors in last 5, 6 years. Okay. So yeah, I am definitely very happy to take on any questions. That's it from my side. But before that, please send in your questions. But before that, there are few questions that we received. I would like to address those questions, and after that, I'm happy to take more questions if you have it. So one of the questions that we received is about the impact of geopolitical tensions and also about the market outlook. So see, our view is that we're not very good, and we believe not only us, but no one is very good at predicting the markets in the short run. So we don't try to predict the markets in the short run. Anything could happen. These geopolitical tensions have been happening for a couple of years now. When it started with when Russia invaded Ukraine, and now Israel thing, and also India Pakistan issue has been now past couple of months impacted the markets. But if you see over the past couple of years, in the short run, they Im- impact or might not impact. Uh, Impact is also mostly short term, and then markets recover, and they continue their uptrend. That's what we have seen in the longer run. So the point I'm trying to make here is, in the short run, markets are volatile, markets are unpredictable, right? But over, if you have a slightly longer time frame of say about 3 to 5 years, the longer it is, the better it is for you. But if you have that kind of time frame in mind, you can rest assured that the markets are going to be much higher from where they are currently. So if you look at last 5, 6 years, COVID fall we saw in about, I think it was 2020, where markets fell almost, I think 45%, right? We didn't knew what would happen, but look at where markets are. We're way higher from where we were at that point of time. So even next 5 years, we really don't know what kind of issues will come up, and they'll definitely come up. It's not that it's going to be a clear one-way ride up. There are going to be a lot of issues that come up, which is going to impact the equity markets in the short run. But over long run, I think markets have been producing about 12 to 15% annualized returns. If we are able to generate about 5 or 6% alpha, I think over 20% is a very good returns if somebody can produce it. Next question is around our Quant PMS. Is it driven more by momentum, or is it truly multi-factor? Its performance is in a low momentum year. Okay, so this is not only for India but for all the countries. Momentum as a factor is one of the prominent factors. So in good years, momentum as a factor is the one that produces the best results. But also in down years, momentum is a factor that loses uh, most money. That has been the general trend. So overall, the answer to this question is yes and no. Yes, definitely yes. In years when the markets are doing good, most of our returns actually come from momentum. But it is also multi-factor, because even at that time 100% of the returns are not coming in through multi-factor. And times like this, about last 6 months or so, where we have um, very little or even zero uh, allocation to momentum as a factor, right? Because as I told you, there's no clear favorite for us. And whatever markets are telling us that this specific factor would work or not work, we're going to construct our portfolio using that information only. How can I join PMS and what money should I invest there? Again, what money you should invest there would depend on the asset like allocation, where all you have invested till now. So I'm happy if you want to spend some time one on one and do that discussion. Please do write to us or call us, and I'll be happy to spend some time with you one on one. However, the minimum investment size in PMS by regulations is 50 lakhs. Next question is, I have 2 crores of money that I do not need right now, but make it use of to create good wealth. So yeah, again, if you have some money, it depends on the asset allocation, your risk profile, which we will do when you get in touch with us, and we can help you craft a strategy for the next, say, 5 years to create decent wealth. Why don't you keep a stop loss in your small case? So we do have a equity based portfolio where you, if you want to invest smaller amounts of 2 to 5 lakhs, you can invest. uh, what's the reason behind so many stocks? So the answer to this specific question is, see, the strategy is pretty similar in small case and in PMS. Only thing is, because we are not constrained by money. There in small case for platform we are constrained by money, and that's why we have a limited. We are serving smaller investors, and we're constrained by the overall portfolio size. Here there is no any such constraint, and that's why we have been able to make a portfolio which is actually much better than the small case portfolio in terms of risk adjusted returns, right? So here the portfolio might be giving slightly lower return, but because it is much more diversified, it is much more stable, right? That's the point. And why do we don't have any stop loss? Because again, it's on data. We have tried out these strategies that if we keep a stop loss, what will happen? Are we able to add any value over long run or not? What we have discovered is no, we are not able to add any value if you have a specific stop loss for each stock, because it works at some time, it doesn't work at another time. So it's not a very clear strategy that it's going to add value over long run. And that's why we don't believe having a stop loss is actually a good strategy uh, in this kind of framework that we operate. Okay. Okay, so I'll stop now. And Ayush, I'm happy to take any questions if you have received any.
Yeah. So we have received three questions. So Satish is asking that he has that I've invested in Gullak Gear 6 in more than a year. The returns are still negative. So what should I do?
Yeah. So Satish, see, last 1 year we have, I think, close to break even results in that. Uh, and last 1 year hasn't been good, but that has happened in the past also. So the returns that I showed in PMS, those are would be kind of similar trend, at least, that the years that we do well, we have been able to generate even 20 to 30% alpha. The years we don't do well, we lose much lesser. And that's why I think you should take a slightly longer term view in these kind of long only based products. 1 year is, I think, a smaller time really to judge a product. So I would recommend that if your asset allocation is in place, you stay invested, you continue your investments, and over long run, as I said, we are quite confident that equities as a asset class obviously is the best asset class out there. It is. So it should do pretty well over long.
Yeah. And on similar lines on our YouTube live, Mr. Ram Prakash has asked us that he has subscribed to our Good Luck Gear 6, and he's asking if 2 years is a good enough time for seeing visible returns.
Yeah. So see, investing is a game of probability, right? So from the top of my head, what I remember is, are the probability of good luck or our strategies producing positive alpha over a 1 day period is close to 50% only. I think it was about 50 to 53%. So roughly 50 to 53% of the days we will be in profit if we stay invested just for 1 day. Now this probability increases to about, I think, 60 to 65% if we stay invested for a month. For a year, this probability was even higher at about 75 to 80%, right? So if it is, let's say, 80%, that means out of 10 years, 2 years we'll still lose, but 8 years we will be in profit. If you consider 3 years, I think 3 years was the time frame where, in 100% of the cases, at least looking at the historical data, 100% of the cases we were in profit. We were generating alpha over and above the benchmark. So 2 year is somewhere in the middle. I think 2 year, the probability of success again would be about 90%. It's not 100%. It is closer to maybe 90%. So that's the probability that if you stay invested for next 2 years, there's good 90% chance that we will be able to generate alpha over and above benchmark. But there's 10% chance that we would underperform also. So yeah, that's what I have to say.
Yeah. And Saurabh has asked about that he saw the 1 to 6 gear system that we have used for equity and debt in our presentation today. And so he has basically asked if we can do something like dynamic shifting between high alpha and long alpha. And
Yeah.
the way we
So
do it
sort of that
using.
is something that we are currently working on. We've been working on that for quite some time. Uh, I'm not sure whether we'll be able to launch it in the near future, but that is something that we are definitely working towards. If we are able to make it work, that will be the best of both worlds, really. But as I said, timing the market is really a very, very hard problem to solve. But that is something we are working on. But definitely, I'll get back to you, everyone here, in next maybe 1 to 2 months, based on whatever results, whether they are good or bad, whatever it is. We'll definitely cover it in our next webinars as to the progress we are making on that front. But as of now, we don't have any such product.
We can take on any other questions if we have. From any other participants. And there was also one more question, I think, in the last page of the deck. Somebody
Okay.
also asked about the fee.
Okay. So yeah, would you like to talk about it, Ayush?
Yeah, sure. Okay.
Yeah.
So regarding the fee structure, we have in long alpha and high alpha, both of them have different fee structures. Long alpha primarily has three different fee structures wherein you can choose it from. So if you go for the fixed fee, it's 2.4% fixed fees per annum. And we also have a performance-based fee wherein you only pay us if we outperform the benchmark. Okay, so that is 40% performance fee over the hurdle that we take as Nifty 50. Then the third fee structure is a hybrid fee wherein you pay us 1.5% fixed fees per annum plus 15% performance fee over the hurdle, which is again Nifty 50. So you can select any one of these. And as of now, you can also switch between these if you want to. You just have to inform us before the beginning of a quarter. And also in both our products in IALPHA and long alpha, there is no exit load. Yeah. Talking about IALPHA next, so we have two fee structures there. One is the fixed fee. It is 2.4%, 2.5% fixed fees per annum charged quarterly. And the other one is a hybrid one wherein we charge 1% fixed fees per annum plus 35% performance fee over the hurdle, which we take as RBI's repo rate or the deposit rate capped at 6.5% per annum. And also we are running some discounts as of now, so you can get in touch with our team to get more details on that. So we also have one more question here. So it's about what's the future role of AI based advisory in portfolios.
Okay. So I think AI we are using quite a lot. The place where we have found most success is in our business operations. So in our business operations, we do use AI a lot, and we are able to add a lot of value. In our portfolio construction approach, we again are, I'm not saying using, but we are experimenting a lot. We are trying out a lot of techniques there. As of now, we haven't been able to really come out with any specific factor that is adding value. So it has to be, obviously it has to be a profitable factor, but it has to be something which is uh, uncorrelated with our current 100 plus factors that we have figured out. Because if it is correlated, then it will not really add any value at all. So till now, we haven't really found anything that works really well. Uh, but that is an area of research that we are hugely focused on. So, yeah, that's what I have to say about AI.
Somebody, yeah. Somebody also on YouTube has asked if we can work out something on the Bitcoin market or the crypto.
Crypto is something I don't think uh, we will do, at least in the near future. We really don't have any plans. We do have plans to roll out our own mutual fund. So we have applied for a mutual fund AMC, hoping to get that soon. But a rollout of actual mutual fund would take a couple of quarters from here. So that is definitely on the cards, but definitely not Bitcoin in the near future. Maybe at a later stage, but not now.
So if anybody else has any questions, then we can take on. Yeah. So let's just wrap it up. So thank you very much. Thank you so much, everyone, for joining us. And thanks a lot, Vivek, for your time. And we look forward to more such webinars in the future and even more interest from our audience.
Thank you, Lord. Thank you, Ayush. Thank you, everyone.
Yeah. Thank
Bye.
you. Bye.